All right, welcome in. Hope y'all had a good weekend. Um, let's go through kind of what happened at the back half of last week, which was more eventful than the first half of last week. I think I want to say my Tuesday or Wednesday, there was a kind of mini sell-off hitting from pre-market. A lot of traders got caught off guard with that one, right? Andrew was the one telling you guys buy the dip, right? And for me, I was watching something else which was hoping that it would develop into a trade idea, but it never did. And that was the VIX, which saw a lot of a short squeeze, which didn't kind of become a gamma squeeze or a delta squeeze, so it remained just a short squeeze, which basically is like a more baby level squeeze. Because there are like three levels of a squeeze that can happen. One is a regular short squeeze. That's when shorts get squeezed out of their positions, which is what happened to retail traders on the VIX last week. They were all short the VIX, thinking the market is going to go higher, 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 until some market participants decided to buy the VIX, causing a big, closing out of short positions, which then caused the VIX to spike, which also had a secondary effect on the ETFs and the indexes. Now, not to help this situation, but CRM earnings, which posted a little, they obviously met guidance, but then their forward guidance was sucky. Then decided to spook the market, sending AMD, NVDA, and a bunch of semis down in fear of AI thematic basket slowing down. This caused a lot of accelerant flows for taking profits, which is the reason why the market threw a fit on Thursday and Wednesday. Okay. Now, I was hoping that the squeeze will continue and then I would be able to play VIX long, but it didn't, carry on the next day. So I didn't enter the trade. Though I will be more mindful of doing that sometime like after FOMC more than likely. So from the index perspective, nothing has really changed. In fact, if anything, we've just been retesting these very key levels of support. You can see we broke down and then immediately got bought up into this. So this wasn't even a breakdown. This is pretty much just a fake out, shakeout scenario, right? And it looks like SPX wants to continue to climb higher here, and NASDAQ is catching up. Now, this is a good sign. The reason why I say this is a good sign is because one thing that you need to take note here is that the indices, in terms of the sectors, have been very strongly flowing into other sectors except for tech. What does that mean? That means the breadth of the market is getting stronger, which is good. And especially if the breadth of the market is getting stronger without tech, then that's even better. Because then when tech rotates back into things, as we mentioned, this is 2 weeks ago, we talked about sector rotations, right? Not the last week, I think the week before. So 2 weeks ago, we spoke about impending sector rotations. Now those sector rotations are halfway done. So we're looking for those sector rotations to complete, and then tech rotates back. So when tech rotates back and the rest of them have already held their position, imagine where the market will be, right? So from my view, still for the next, couple of weeks at least, we will see the continued strength. So let's have a look at where the sectors were for the past week, and you can have a look at this on finviz.com. You can click on groups and you will see this. And obviously you can choose whatever you want, like performance, bar chart, whatever. So I like the bar chart because it's just very straightforward. But let's look at the 1 week performance. So you can see the 1 week performance here. Your top performing sector was communication services, which means Meta and what's the other one? Was it Amazon? I don't know. Meta and something else. Uh,
Google.
Google. There you go. Oh yeah, that makes sense, right? So Google into all-time high price discovery, and then Meta also kind of holding its ground. So that gave you a pretty big lead in communication services last week. Google with the antitrust case being reversed, and then Meta just being Meta, right? Second to that, all of these sectors were kind of dog shit, right? Even you can see financials and tech were two of the weaker sectors last week, which is a classic sector rotational habit, right? These two are always moving in tandem most of the time, or at least at the beginning of earnings season, financials will usually rally first before tech does. And if you look at the 1 month performance, now communication is actually leading as a sector, and healthcare is now back, right, into the lead. Where healthcare was out of rotation, now it's getting back into rotation. Now, remember, not all healthcare will be profitable. Not all healthcare will perform the same. Only the strongest in healthcare will perform better, right? And you can see here, technology and financial still kind of lagging, actually. And if you look at the 3 month performance, then you'll see that technology is actually not doing that bad, right? So this is a much needed pause slash pullback in order for us to get moving higher, okay? Year-to-date performance, communication services, then basic materials, then financials, then technology. So that's where we are for the year, okay? And obviously the biggest macro change from this past week is the 10-year yield, right? This is a very important one that we've been talking about for weeks. I've told you guys this is a downward kind of megaphone pattern that's been forming, right? The 10-year yield was just here last week, and then on the news of, jobs, right? Weaker job report, that strengthens the case. I wrote a whole blurb about this. It strengthens the case for the Fed rate cut. So where are we with the rate cuts now, right? Because now the 10-year yield is down, right? What does that mean? That means the Fed is going to be easing monetary policy, okay? But where are we in terms of the meeting probabilities? Let's have a look at that, right? So comparison. Now, remember, start to learn how to read this chart, right? Where is the current 10-year yield? We are currently at 4.33%, right? Okay, sorry, not the 10-year yield, but the interest rates, right? The interest rates right now are 4.33%. So in September, which is in 10 days, the market is pricing in a 92% chance of a rate cut. Okay, so we're back to the 90s. Remember how we were in the 90s? We came out of the 90s. Now we're back in the 90s, right? That's how quickly the market changes its tune. Now, for the October meeting, we are up now to 72% for another rate cut. And then in December, 65% for another rate cut. So the market's pricing in 3 rate cuts before the year ends, which I call bullshit right now. Okay? I've called bullshit on this for a while. I call bullshit on it right now again, because you guys know that there's a very low chance of that happening, right? I say we get the September rate cut. That's probably fair, right? And then this week you'll have CPI, which will also determine how the Fed's going to move. For those of you that don't know, this week you have PPI coming out first and then CPI. So have a look at the calendar. This is the week, right? You'll have PPI on Wednesday, and then you'll have CPI on Thursday. Usually it's the other way around. Sometimes happens like that. I think it's just the reporting dates that both of those administrations do, right? So apart from that, you don't really have that many other important pieces of news. Okay. I don't know what is this one. Preliminary estimate for annual benchmark revision of NFP data. I don't know what that is. I don't even care. Okay. But CPI, PPI will be the main thing. Remember that if inflation comes further down aggressively, then that's going to cause further confusion for the market. Okay. So that's where you are in changing macro policy. Now, yield curve as well. You can see that the most affected by the yield curve this past week was actually the 3 to 4 month yields. Okay. These are starting to flatten out a bit now. And remember, at some point of time, this part of the curve is going to come back up, right? This part of the curve will come back down, and then this part of the curve will stay higher. And that'll be your standard, right, yield curve, okay? But it's going to be a while till we get there, because right now, people are very spooked with the 1-year term. You can see where the fear is in the market. If you learn how to you read the yield curve charts, you will always know where market participants are fearful. So for the next 1 year, all these fools are pretty fearful. Well, they get less fearful approaching 1 year, but up to 4 months, this is like pretty fearful, right? After 4 months, it gets lesser and lesser, because you can see this is where the crowded trade is. Everyone is holding bonds between 1 year to 5 year. This is where everybody is holding bonds. That's why yields are so low, right? So it'll take a while for this to kind of flatten out, and then the this part will stay the same. This part will kind of flatten a little bit, and then this part will come down further. So we'll see that, and I'll show you guys how that will happen over time, right? So that'll be this re-inversion of the yield curve back to normal. Now, I'm not even going to touch beyond December in this probability meetings because it really doesn't matter. You will see this is going to change a billion times. But we'll go through it every week so that you can understand, right? And if you look at, I'm not going to go through the technicals because for me personally, there's not much to add here. I think Andrew will give you more insight on this. But from my perspective, it's just basically either an all-time high scenario or a pullback to support again, right? Which has been the case for multiple weeks. The one that I do want to talk about though is IWN, which is now at a very good price, right? 237. So if you bought this dip here, you would be sitting pretty, right? And now as the rate cuts start getting priced in, I mean, it's already priced in, but as it starts goes into fruition, where people are actually seeing the rate cuts go into practice, then IWM may start to break out sometime next year. Okay, so remember, if you don't own small caps right now, that's fine. Wait for a pullback. Don't buy it right now. Okay. The other piece of the puzzle, the dollar, which has been kind of confusing in the past like 2 months or so, even more than 2 months, right? This is a weekly chart. But it's been very, very low. It's been chilling down here. Now, I don't mind a cheaper dollar. This is great for equities. But at some point, this is going to mean revert. Okay, this will mean revert back up to about 101 or so. And so watch out for that in this at the same time when the 10-year yield decides to mean revert. Okay, that'll be your index pullback, protection hedging, all that kind of stuff, right? That'll be your macro move. I think that obviously happens a bit lower when this goes a bit lower, right? Maybe when it's just approaching box at 4%, maybe in the next 1 to 2 weeks. And that will time perfectly with the FOMC, which is what I usually tell you guys. When the Fed cuts rates, the first reaction is usually a sell-off. And then after the sell-off comes the buy-up. And that sell-off is usually a lot of the time used to fake people out, okay? Now, some setups that I'm looking at for this week are actually just overall setups. ASML, if you don't own equity of this, great one to buy, right? Still undervalued. If you don't own diversified risk within semis, you can buy this one. This is a monopoly. Remember, there is no other business like this. They create the lithography machines that are required to make fabs. Okay, so this is a great one to buy if you haven't bought it. Okay, NVDA and AMD, both of these last week were absolute dog shit. Why? Because of the semis basket being, frowned upon. Now remember that these both, when they do come down, are incredible buying opportunities. If NVIDIA does break this level this week at 164, 163, right, and it does not fake people out, remember, watch for it to hold below this level, first of all, right? If it breaks below, then it has a pretty far down way to go to about 150. And if you still aren't buying NVIDIA at 150, then that's fine, right? That's fine. But then don't at us when NVIDIA is at $200 in a year from now, okay? Because this one is obviously one of the stocks that you want to put in your portfolio for a longer term. And even if in the short run it goes down, up, you should continue holding it. All I'm saying is very soon you'll have an opportunity to add this at a lower price again, okay? And the same thing with AMD. If AMD breaks here, then it's likely to come back all the way down to 133 for support. So I don't know if it will actually do that. So let's see what it's going to happen this week. Okay. Tesla, very nice consolidation, still consolidating. We had some slightly bullish news. Well, not bullish for us Tesla investors, but very bullish for Elon Musk, where he got $1 trillion pay package that's being negotiated, pending board of approval, pending court approval. So remember, that's just a news headline to get Tesla investors salivating and excited, right? But from a technical perspective, I think it's no secret that we've been aiming for 350 for like weeks on end now, right? When it was down at 317, we've been talking about 350 for a very long time because that was the key level. Now, if it can come back this week to kind of bounce on 345, which it has in this past week, I would be happy to potentially take a trade here, right? There is a nice potential day trade if we can bounce on 345, right? Somewhere here. It's bounced here before multiple times. So if it comes back down, bounces here again, then that might be a nice catapult up to 360, which is only a day trade or scalp. Remember, do not swing this thing. Okay. I want to be very cautious in the way that you play it, because Tesla can just burn your premiums overnight and you won't even know. It's that volatile, right? The other one that's doing good work is Baba. But this is more of an equity play that we've been holding for a really long time. And honestly, it's about time that it starts to move, right? So those are the main opportunities that I see this week, the things that I like. I'm really hoping that we get this short position on NVIDIA and AMD, but I'm not holding my breath on it, because if the market's strong and tech is strong and it rotates back, then semis are going to pop again. And then a lot of the people who are betting short on AMD and Tesla are going to get burnt. So wait for the break below. Wait for the consolidation and rejection below. Only then do you enter short. And if you are entering short, take your profits quickly on these, because the thematic momentum behind semis is still very strong. It's just that these opportunities happen when the market gets into panic. Okay. So that's kind of where we are. That's where I'm. That's all I have for this week. If you have questions about macro, you have questions about anything to do with individual tickers, feel free to ask me in the chat. But I'm going to hand it over to Andrew now to do his bit.
I do know, I think it was on Saturday morning, someone asked me, where do you think we are within the credit cycle based on the video that you posted?
Oh, okay.
If you want to share some insight for the group.
So based on Ray Dalio's cycle, we're in like the third out of the fourth inning of a bigger depth cycle, and that lasts typically like 8 to 10 years. So you're probably like a little less than midway through that. So you probably have like another 7 years or so, 6 years. Um, of course, this is like super hard to even try to predict. Nobody knows. But here's a good indicator for you to understand when the depth cycle, the bigger depth cycle, will pop. It's when the US GDP stops growing. Okay. And the reason why America's debt problem is not a big deal to global investors and why the US still remains a reserve currency is because their economy grows at a rate that no other economy grows, right? America's economy is many, many trillion dollars. And each year, there are big tech companies that add GDP to that. Do you guys know any other tech companies around the world that do as much business as US tech companies? The answer is probably no. And so, if you're basically, the way the US looks at the debt problem is, if my sales continue to grow, then I can continue to fund my debt, which a lot of countries do. Singapore does this, just FYI. We don't actually have any debt in our country, but we still take on debt, right? Like, we don't need to take on debt, but we do. Why? Because we can. So America uses its reserve currency status to take on debt. And so if you're wondering when the big cycle pops, I know that's what's on your mind, right? Whoever's asking this question, because you're probably thinking, when is the thing going to pop so I can short the market, right? But that's not going to happen for a long time. Until and unless you see our GDP contracting for like 4 quarters straight, right? And I'm not talking about one GDP contraction, because that's nothing. GDP contracting for 4 quarters, that's when I consider a recession. Now they've changed the terminology to be 2 quarters, which is stupid. Last time it used to be four. And I think it's still the best measure. If for 1 year GDP is down, then yeah, your economy is in recession. And if borrowing costs continue to rise and the Fed does not rise interest rates, then it becomes a problem. Okay. So that's to answer the question. Oh, also, sorry, one last thing before I fully hand over. I am very, very surprised that very few of you have signed up for the courses. We have like maybe about 5 or 4 signups, but you should really be getting on this until next week. You have one more week to sign up for the courses. The becoming a market maker and positioning like a market maker. There are a few signups. And also another thing I gotta mention is some of you are signing up separately when you can sign up together. I wouldn't do that. There is literally, I've created a link for you to sign up together in one page rather than you having to do it twice. So make sure you're looking at the message and selecting the right link based on what you want to sign up. If you're signing up for the bundle, there's a link exclusively for the bundle. Please use that one because then it won't get confusing for me. If you do one and one, I have to pull two Excel sheets and put your name into both of them. So uh, just keep that in mind. But you should be getting on the signups as soon as possible because in a week from now, the early bird's over, right? The 14th. Okay. So you guys have this week to sign up. And then after that, the early bird offer will go away. And then it's basically 2 weeks from there. We're already in becoming a market maker course.
All right. I agree because a lot of stuff I'm about to go over is going to go over a lot of people's head. But if you take the class, it makes a lot of sense and the puzzle starts to get a lot more clear, which is what we talk about. So, with that, let me share my screen and we'll get into the data side of things. So, we were on a really good hot streak, 4 weeks in a row. We nailed it. Then we had one off week. And then last week, we absolutely nailed it again. Nailed the bottom target on the first day. And then the rest of the week, we just rallied into the upside. So, what are we looking at this week? Well, let's start by taking a look at where the positions are. So, if we go to the playbook, we can see, scroll up here to the top, some interesting stuff. So the first thing, if we're looking at Friday's flow, we can see that SPY is a little bit bearish, while SPX can show bullish positioning up towards 65.20, right? If we look at the 5-day, which is all of last week's flow expiring on Friday, we can see that SPY is pretty bearish, but also remember that SPY is used as a hedge. So bougie, stop. But SPY is used as a hedge, so a lot of the times it's going to be bearish. SPX, again, we can see the bullishness. And I just want to point this out for people that use the algo. When you see something like this, right, price is clearly selling off and they're not selling their positions, they're actually increasing their position size. That should give you some indication into what possibly could happen. Now, obviously, you don't want to just follow something blindly, but you'd look for key levels, right? Like 6,400 was a key level. So over 6,400 going long was a pretty safe move, right? And you can see something similar happening here, right? We sold off and they held their positions. And now you've got this kind of box here, right? And so if price gets over this, there's a very good chance that it can make a move back up into the upside here, right? Now, what most people are going to look at here, and I'm not saying they're wrong, but they're going to look at this as a bear flag, right? And so they're actually looking for this. The retail trader is looking for this because that's what every stupid fucking guru on Instagram is showing. Hey, guys, you draw a little flag here and look for continuation and it'll fucking work. But in reality, you can see bullish positions being built to the upside. So if the flag doesn't play out and it goes like this, you understand why, because there was positions up here. And you go, but I totally thought it was going to break down on the bear flag, right? So understanding what is happening from a data standpoint can give you a little bit of an edge. And then for the month, it's the same thing. If we take a look at the NAMO, I'm not particularly excited here. As you can see, we have a little bit more upside here. But where I like to get aggressive is when this gets overextended. And if you can get into it when this is overextended and this is overextended, then that's a great setup. As you can see, we're kind of just chilling right here in the middle of, I call it no man's land. And we have a little bit of room here, probably to the upside. So again, if we were to break to the upside, I wouldn't be surprised. If we came back down, also probably wouldn't be surprised. But it's not a great place to get in. We take a look at sector rotations. T just talked about it, right? Tech and finance have been pretty weak. And so if those wake up, there's a very good chance, right, that the market could rally. This is what last week's rotations look like. So obviously Google leading the charge here. But you can see that if tech wakes up, there's a very good chance, right, that the market is going to move to the upside. This is one of the things that a lot of people get wrong. They don't think that SPY can be strong without tech, right? SPY can very easily continue to melt to the upside, even if tech is not involved. So this was a good example of how the market can just kind of melt or grind or consolidate and doesn't have to pull back just because tech is pulling back, right? So this is how they manipulate the market to continue to move higher without having tech lead the rally. So when tech wakes back up, the market explodes again. Everybody's happy except for the bears, but Andrew's pretty happy. The bears are pretty upset, and we go on with our cycle. If you take a look at September, keep in mind that we do normally see a new high, which we got last week. It's the back end of September that is usually pretty bad going into the quarterly expiration. Okay. So we're kind of at the beginning of September. We're kind of in this-ish area. Could we get some bullishness this week? Maybe. It's the back end of September going into October that can usually be pretty red. And then actually that dip in October is a buying opportunity for the back end of the year. Okay. So we'll see if we get that. I think we will. The other thing I want to point out is this is one of the worst weeks of the year. So week 36 is usually a pretty poor performing week, followed by 39, which goes into that quarterly expiration. Here's your other ones. But this week is not a great week. Make sure we mute that, people.
Yeah, I got it. Hold on one second. Let me see who's it. I got it.
Cool.
Wait, why can't I mute them?
I don't know. So this is not historically one of your best weeks to be getting crazy in the market. Fear and greed, we're still kind of chilling in that greed area. Nothing too crazy there. So let's get into the data. Okay. If you guys remember, we had positive gamma support here at 635. Now, if you go back and look at how price performed, we'll just go here to this 1 hour mark. Last week, you can see that price bounced right off of 635, right? So this is why this data is so important, because it gives you insight into what levels to pay attention to. So we had talked about it. If price were to break below 640, there's a good chance it comes down into 636. And if it breaks 636, then it probably comes down into 635. And if 635 holds, then that could be a buying opportunity, right? And so you can see that we came off of that level twice, right here and right here. So we want to pay attention to that, because if we take a look at the gamma exposure this week, we can see that 635 is the biggest level of exposure here. So what does that tell us, right? We can see it on this one as well. We have multiple sources, right? If we come in here and we take a look at this one, and we go to this week, which is the 12th, you can see that 635 is the biggest level of exposure, along with 652. So if price were to break below 645, you would add selling pressure, which would drive price down into this dark pool level, which is where we bounced. That's a $4.1 billion area. If you were to break this level, then you would come down into most likely 640, which would bring you into this golden pocket area. And if you break 640, you're going to add more selling pressure, which is going to drive price down into 635, right? This is how it would work. So if this is a bear flag, and that's what you're living on, and price breaks here to the downside, 645, then you'd look for it to come down into this dark pool level, which is where we bounced. If we break this dark pool level, which is 643.22, you guys should be taking notes, hopefully. That would drive price down into 640, which 640 is a dealer long position, meaning they would have to hedge here. and we'd also be in negative gamma environment. That would create selling pressure, which would drive price down. We would obviously hit our bearish target, which is right here, and possibly further down into 635, right? So as we look at this from a data standpoint, we can see that 635 is the biggest exposure level here. Okay. Now, if we take a look at the next week, obviously we talked about 635, we can see that the third week, 926, you have positive gamma at 630. So if for any reason we break 635, there's a good chance we come down into 630, where again, this would look like support. We would see buyers come in here. Now, the dealer side is a little bit different. We have dealers long at 635, which means if price were to break below here, they would have to sell shares short to hedge, right? If you don't understand that concept, you're gonna have to understand that there's two sides to every options trade. If you look at the next week, 919, dealers are short 635. So we call this a flip point, where dealers would have to sell shares short to hedge here, and they would collect premium here. Okay. So dealers are selling shares short here, and they're collecting premium here. Okay. Dealers are long 645 and 640, which means if price breaks below 645, they have to sell shares short to hedge, which would drive price down into 640. And if they break 640, then they're selling shares short on both of these positions, which is driving price down. Okay. So really easy evaluation. If price is below 645, no upside. If price is below 640, no upside, right? And then lastly, dealers are short 630. So if dealers wanted to kill all of these positions, they would drive the price below 630. So dealers, if we look at these two expirations, 926 and 919, they want the price below on these positions. They want the price above these positions. So if the price gets below these positions, they have to hedge. And if the price is above these positions, they have to hedge. Okay. So those are areas that you would look to take opportunity in based on the price action that you're seeing there. So if we now take a look at the chart and we say, okay, well, what could we see? If 645 holds, which you can see right here, it's holding, then that would tell us that dealers are not selling shares short, which means we would look for a retrace up into 650, right? That's what the algo was showing us. If price breaks below 645, then we will look for dealers to sell shares short, which will drive price into the downside towards 640. If price gets over the 650 level, then we would be over the golden pocket. We would look for the buying pressure to kick in here, which would drive price back up into the high. And if price breaks the high, then there's a very good chance we continue up to our bullish target, which is 655. So that was a lot that I just went over. So if you're in the Discord, which hopefully you are, I have a full right here so you can read it, right? So last week was a great week. We opened it at our bearish target and bounced right off the positive gamma support at 635 for the second time. This created a great buying opportunity as we rallied the rest of the week all the way up to 652.21, only to sweep the previous highs and close the week back in the weekly range, which leads us into this week. As you can see from the seasonality section, week 36 is one of the weakest weeks of the year. If last week's liquidity sweep was a sign, we could be looking for some downside. Based on the algos, I'll be watching for 645 to hold as dealers are long here and drive price up into 650. If the buying pressure of 650 does not kick in, this might be our high for the week. If we break 650 and buyers step in, we can easily push back into all-time highs with a target of 655.93, our bullish target. Now, if 645 does not hold, things might get slippery quick. As we can see from the 919 expiration, dealers are long both 645 and 640. This could create selling pressure to the downside. The first level to watch is 645. If we break here, this can start the selling pressure as we target 640, the golden pocket, and 638.55, our bearish weekly target. My concern is we might not stop here. as a break below 640 would add a second wave of selling pressure as we target the gamma exposure of 635 again. Our last line of defense is our gamma support at 635, which has been strong. If we break that, we can easily see 630. As 635 is a gamma flip point, we might see some more volatility this week. So be careful. Okay. So that is what we're looking at. Hopefully, you guys paid attention to those levels. They will most likely play some type of effect in the week, regardless of whether it's in the pre-market or if it happens when market is open. So with that, I will open it up to you guys and your questions. Bougie, that was not your turn to bark. Stop, Bougie. And then real quick, for people that are on the Fuck Your Furu server, I added the mid-month updates. So now I will post them. I'll post them in here, but I'll also still post them all here. So you have one place where you can see all the stocks that have hit their targets. So, and then you can make your adjustments. There. Still need to add a new ticker for this month. Flip point means that dealers are long and short. So essentially, if you were to break that point, they would sell share short to hedge, but they'd be collecting premium on the other position. So there's really there's no effect to them. And this is why the Becoming a Market Maker class is a great class, because we go over all those concepts that I just talked about in detail, from the way I see the data and the way that T sees the data. So from both angles. Stop, Bougie. Bougie, stop it.
I was going to say also another thing about the classes. So I received quite a few messages from people who are like, okay, I'm having trouble to pay for it, or whatever scenario you're in, but essentially you need help with payment, right? We will allow anyone to do a payment plan, provided the fact that you pay everything before classes start. And I think that's very fair to everyone, and that's very fair to us. So if you need the payments broken up into a certain amount of payments, DM me. But we need to work it out privately, and I'll need to create a custom payment link for that. So you have to give me some time to do that. So I just thought I should mention that if you're having trouble with, oh, I can't come up with this sum of money for this particular class, but I really want to do it, which I don't recommend you stretching your budget. But if you do want to stretch your budget, then what you should do is DM me so that we can work it out. Okay.
Yep. All right, no questions? Man, you guys are a quiet bunch. XOM. Yeah, XOM hit the target. So I could still come down a little bit more.